No, you wouldn't. You'd just shop at another store. The banking system is no different. The Fed's job isn't to ensure that banks never fail. The Fed's job is to ensure that people have confidence in the banking system as a whole. More recently, the Fed has been charged with implementing laws governing consumer credit. You've probably heard of the Truth in Lending Act, or the Equal Credit Opportunity Act, or the Home Mortgage Disclosure Act. This casts the Federal Reserve in the role of law enforcement rather than banking or monetary policy. The Fed's roles in payments and supervision are usually done behind the curtain. It's like your appendix. Most people never need to think about it, and if they do, then it's because something went wrong. But that's not true of the Fed's third main function, which is devising and implementing monetary policy. Monetary policy refers to the Fed changing the supply of money in the U.S. economy. If money is plentiful, then credit is easier to get, and interest rates tend to fall. The idea is that this induces people and firms to borrow money, to spend, and to make investments. That should boost the economy. It's not that simple, of course. Lower interest rates affect the income of lenders, too. People who buy bonds and other debt securities have loaned money to the bond issuers. The lenders have less income when rates are low. That means that they have less to spend, and that slows the economy. Economies are complex, and trying to fine-tune them is a tough job. Moreover, economists have lots of different definitions of money. Not all economists even agree on which of them affects the economy the most. M1 includes all coins and currency plus demand deposits, which are mostly checking accounts. M2 adds savings deposits and certain small deposits with withdrawal restrictions, plus money market accounts not held by institutions, and some important bank funding tools. M3 is the broadest measure of the money supply. It equals M2 plus all large time deposits, institutional money market fund assets, and other larger liquid assets. Most people play fast and loose with language when they refer to the money supply. Most of the time, they don't say which one they mean, and usually it doesn't matter too much. Most likely, though, they mean M3. The Fed changes the money supply in three ways. First, the Fed can change the discount rate. The discount rate is the interest rate that the Fed charges banks on short-term loans. In practice, the discount rate is more important as a policy signal rather than as a way to change the money supply. It's a way for the Fed to tell the world where it thinks interest rates should be. The second way that the Fed changes the money supply is by changing reserve requirements. Like most countries, the United States has a fractional reserve banking system. When you deposit $100 in a bank, the bank only has to keep a fraction of that $100 on hand. The reserve requirement is usually around 10%. That means that the bank only needs to keep $10 of your $100 on hand and can lend the rest. If the Fed wants to tighten the money supply, then it can raise the reserve requirement to, say, 12%. That would mean that the bank would only be able to lend 88 of your $100 deposit, so credit would be tighter. In practice, the Fed doesn't change reserve requirements very often. It's less disruptive to conduct what people call open market operations. To increase the money supply, the Fed buys securities in the financial markets. That puts money into the financial system, increasing the money supply. You'll hear that the Fed injected reserves because the new money eventually goes into the banking system somewhere, and collectively, the banks have more reserves as a result. When the Fed drains reserves, it reverses the process. It sells securities from its inventory. Buyers take money from their accounts and send it to the Fed in exchange for the securities. That reduces the money supply. The Fed uses open market operations far more often than changes in the discount rate or reserve requirements. You might ask why the Fed tries to affect interest rates.